Welcome to Lecture 5, Building a Tax Benefit Model. Lectures 2 through 4 gave you the conceptual foundations, research design, the major UK datasets, and the measures of poverty, inequality, and fiscal incentives. This lecture puts all of that to work. You're going to build a tax benefit microsimulation model in Python, run it on synthetic household data, and use it to analyse the distributional effects of policy reforms. This is the lecture that most directly demonstrates why quantitative skills matter for transformative policymaking. A tax benefit model is the core analytical tool of distributional policy analysis. Once you understand how one is built, how it is validated, and what its limitations are, you will be equipped to use, critique, and commission this kind of analysis throughout your careers. We need to be honest about failure modes. We do not present microsimulation as a perfect analytical instrument. We present it as a useful, transparent, and appropriately limited tool for answering important questions, and we explain precisely which questions it can and cannot answer and why. If you have access to an account, please have Practical Demonstration 4 open alongside these slides. We cover 10 topics in this lecture, moving from the basic logic of tax benefit modelling through technical detail to a reflective assessment of what the method can and cannot achieve. The first 3 topics establish what a tax benefit model is, how it is structured, and how we check whether it is working correctly. Topics 4 through 8 confront the main failure modes: wrong tools, unclaimed benefits, tax measurement errors, behavioural responses, and macroeconomic feedbacks. Topics 9 and 10 provide the intellectual framework that holds the whole lecture together. The case for accepting useful imperfection rather than waiting for a model that can never be built, and the extension of basic microsimulation into long-run poverty forecasting using reweighting and uprating. By the end of this lecture, you will understand why the Landman tax transfer model analysed in Lecture 6 is structured the way it is, and why the limitations it acknowledges are genuine but not disqualifying. A tax benefit model is, at its core, a simple idea. Take a representative sample of households. For each household, apply the rules of the tax and benefit system to calculate what they would owe in tax and what they would receive in benefits under a proposed regime. Sum the results across all households. Scale up using grossing factors to produce population-level estimates. The outputs are precisely what policymakers need to evaluate reform proposals: the net fiscal cost, how many people gain and how many lose, what the effective marginal tax rates look like across the income distribution, and what happens to poverty and inequality. These are not abstract statistics, they are the numbers that appear in budget red books and in the distributional analysis published by the Treasury and the Institute for Fiscal Studies. The model you will build in this lecture uses synthetic data rather than the actual Family Resources Survey for the privacy reasons we discussed in the Lecture 3 session. Synthetic data has the same statistical structure as the real thing, which means the model behaves correctly and the outputs are interpretable. But for published policy analysis, the actual FRS data accessed through the UK Data Archive is required. The Landman tax transfer model, which you will use in the next session, runs on real FRS data. The critical caveat, which the textbook states at the outset and returns to repeatedly, is that the model calculates formal incidence, what people are legally entitled to and liable for. This is not the same as what they actually receive and pay. The gap between entitlement and receipt is the subject of the non-take-up section later in this lecture. The UK tax and benefits system is extraordinarily complex. Tolley's tax guide runs to multiple thick volumes. The CPAG Handbook is a substantial book covering thousands of eligibility rules, taper rates, capital limits, and special cases. No microsimulation model attempts to implement all of this. The art of model building is deciding which rules are material to the questions you are trying to answer, and which can be simplified or approximated without significantly distorting the results. The model flowchart traces the logic, load the dataset, uprate incomes and prices to the current period, calculate each household's income tax liability, calculate their benefit entitlements, and aggregate across the population. This sequence must be followed in order because later calculations depend on earlier ones. Benefit entitlements often depend on net income after tax, which means tax must be calculated before benefits. Uprating is worth explaining in detail because it is easy to overlook and consequential when wrong. Survey data is typically 1 to 3 years old when it enters a model. In that time, average wages may have risen by several percent. The general price level will have increased, and benefit rates may have been uprated by CPI inflation. If the model applies current tax and benefit rules to historical income levels without adjustment, it systematically misrepresents the fiscal position of households. Uprating addresses this by multiplying recorded incomes by wage growth indices and recorded prices by inflation indices, so that the synthetic household population reflects current economic conditions. Validation is how you establish that your model is doing what you think it is doing. The textbook identifies two approaches that are conceptually complementary but practically independent. Bottom-up validation works from individual households upward. You take specific test cases, a single person on £30,000 a year, a couple with 2 children, and one earner on £25,000, a pensioner on state pension only, and manually calculate what their income tax liability and benefit entitlements should be under the current rules. You then run the model on these households and check that the model's outputs match your manual calculations. This tests whether the individual calculations are coded correctly. Top-down validation works from published statistics downward. HMRC publishes total income tax receipts. Department for Work and Pensions, DWP, publishes total benefit expenditure. If your model predicts that a baseline system generates £220 billion in income tax revenue, but HMRC actually collected £248 billion, something is wrong at the aggregate level. This does not necessarily tell you where the error is. It could be in the data, the uprating, the modelling of specific reliefs, or several other places, but it tells you the model is not accurately representing the overall fiscal position. The counterintuitive finding is that these two forms of validation are not equivalent. A model can achieve good aggregate performance while getting individual household calculations systematically wrong because errors at the household level cancel out when summed across millions of households. And a model that gets every individual calculation precisely right may still produce inaccurate aggregate totals if the underlying data is systematically unrepresentative in ways that grossing factors cannot fully correct. For distributional analysis, which depends on getting the relative positions of different household types right, micro-accuracy is critical. For fiscal costing, which depends on getting population-level totals right, aggregate accuracy is what matters. Both are needed for credible policy analysis. Knowing which computational tool to use in a given situation is a professional skill that distinguishes applied economists who can work effectively in institutional settings from those who can only work in idealized conditions. Spreadsheets are the near-universal tool in government, think tanks, journalism, and most commercial policy analysis. They are excellent for many tasks, quick calculations, charts, presenting results to colleagues. But the academic literature on spreadsheet errors, extensively reviewed by Pankow and the Eurosprig Group, consistently finds that most real-world spreadsheets of any complexity contain errors, and that these errors are rarely detected by their authors. For modeling complex tax and benefit interactions across thousands of households, spreadsheets are genuinely dangerous, not just suboptimal. Statistical packages like Stata and R are the workhorse of academic empirical economics. They are excellent for the kinds of regression analysis you encountered in lectures 2 and 3, and for data manipulation and analysis generally. R in particular is free, powerful, and the standard tool for quantitative social science research in many disciplines. High-level programming languages, Python in this lecture, are better suited to the rule-based iterative logic that tax benefit modeling requires. Python has become the dominant general-purpose language in data science and policy analysis over the past decade. Its readability, its extensive ecosystem of analytical libraries, and its widespread adoption in both academia and government make it an excellent choice. The UK Treasury's own tax benefit model runs in SAS, a statistical package not naturally suited to rule-based programming. SAS is used because it is the standard throughout UK government, and institutional familiarity and technical infrastructure outweigh the awkwardness of applying SAS to a task for which Python or Julia would be more natural. This is a rational institutional decision. The lesson: choose your tools with awareness of both their technical properties and their institutional context. Non-take-up is the most practically significant gap between what a tax benefit model calculates and what actually happens in the real world. The model calculates formal entitlements, what each household would receive if they claimed every benefit for which they are eligible. The FRS records actual receipts, what they actually claim and receive. The gap between these two figures is non-take-up, and it is substantial. Most non-take-up is concentrated in small entitlements. This is consistent with two very different explanations. The rational explanation: if you are entitled to a very small benefit, but the process of claiming it is time-consuming, documentation-heavy, or stigmatizing, the rational decision is not to claim. The cost of claiming exceeds the expected benefit. The modeling error explanation: if the model incorrectly calculates small entitlements for households that are not actually eligible, the apparent non-take-up is just the model getting the rules wrong. The correction approach is the same regardless of which explanation is correct. Build a statistical model that predicts, for each modeled entitlement, the probability that it will actually be claimed. The predictors include the size of the entitlement. Small entitlements are less likely to be claimed, and household characteristics like age, family structure, and disability status that affect both genuine take-up behavior and the likelihood of modeling errors. This correction is applied in sophisticated models like the Landman TTM, but not in the simplified teaching model in this lecture. The practical consequence for this lecture's model is limited. Because non-take-up is concentrated in small entitlements, the aggregate cost estimates and the income level estimates are approximately right. What the uncorrected model will overstate is caseloads, the raw number of people receiving each benefit. Caseloads matter enormously for public administration. They determine how many universal credit case managers DWP needs, how many computers the benefit processing system requires. But for distributional analysis of income changes, they are a secondary concern. The pattern of errors in tax modelling differs systematically between direct and indirect taxes, and understanding this difference matters for interpreting model outputs. For income tax and national insurance, the errors tend to be roughly random. The model overstates liability for some households and understates it for others, with no clear systematic pattern. This means that when you aggregate across the full sample, the errors partially cancel out, and the total predicted income tax revenue is often reasonably close to HMRC's published figures, particularly after the high income correction that replaces reported incomes for the very richest FRS respondents with values imputed from tax records. Indirect taxes are a different story. As we established in Lecture 3, the LCF records spending on alcohol and tobacco at roughly half the level that HMRC customs and excise data implies it should be. The standard correction is to multiply all recorded alcohol and tobacco spending by a factor of approximately 2 so that the model's prediction of alcohol and tobacco duty revenues matches the actual data. This works for aggregate accuracy, but it may worsen distributional accuracy for a subtle reason. If the gap between LCF and customs data reflects genuine understatement by survey respondents, people who drink accurately report whether they drink but understate how much, then the correction, applied to everyone who reports any drinking, will produce broadly accurate distributional results. But if the gap reflects undersampling, the LCF is not interviewing enough heavy drinkers, then applying a uniform multiplier makes it appear that a small number of survey respondents bear enormous burdens, when in reality the burden is spread more widely. This is the distributional accuracy paradox. A correction that improves aggregate performance can make the model's picture of who bears the burden systematically misleading. The behavioural response section of this lecture is updated from earlier versions with some genuinely important new evidence. 2 price-based interventions now have strong empirical support for behaviour change, and it is worth knowing this because it directly challenges the assumption that behavioural responses are always uncertain and contested. Minimum unit pricing for alcohol in Scotland, introduced in 2018 at 50 pence per unit, has been evaluated rigorously by Public Health Scotland. The 2024 review finds that it reduced alcohol consumption and associated health harms, particularly among the heaviest drinkers who were the primary target. This is a case where the price mechanism worked broadly as predicted. Making the cheapest alcohol more expensive reduced its consumption among the most price-sensitive consumers. The UK soft drinks industry levy, the sugar tax introduced in 2018, has also been evaluated rigorously. Rogers et al.'s 2024 analysis finds substantial reductions in sugar content in affected beverages. Much of the effect came not from consumers switching products, but from manufacturers reformulating to avoid the levy, an industry behaviour response that standard demand models do not capture, but which produced the public health outcome the policy was designed to achieve. For labour supply, the most frequently cited behavioural concern in income tax analysis, the literature remains genuinely inconclusive. The income and substitution effects of a wage change pull in opposite directions, and their relative magnitudes vary across different groups in the population. The empirical literature has not settled on a consensus labour supply elasticity, which means dynamic modelling of income tax effects would require assumptions that are themselves contested. Macroeconomic feedbacks are the second-round effects that even a well-specified household-level model misses. A tax increase that reduces household disposable income will reduce consumer spending, which will reduce demand in the economy, which will reduce employment and wages, which will further reduce income tax receipts and benefit expenditure. Renn-Lewis's 2016 analysis provides a framework for thinking about these effects. In a static model, these feedbacks simply do not occur. The model world is frozen at the moment of the policy change. This is a real limitation, but the alternative is a much more complex model with many additional assumptions. This lecture closes with the reflection that is important for how you think about the tool you are building and using. There is a temptation, when confronted with the catalogue of limitations described in the previous sections, to conclude that microsimulation is too imperfect to be trusted. We can reject this conclusion directly. The aspiration to a model that fully captures behavioural responses, true tax incidents, intra-household distribution and multidimensional well-being is not just technically demanding, it is fundamentally self-undermining. A model that achieves all of this would rest on so many contested empirical assumptions and require so many calibration decisions that its outputs would always be open to challenge on methodological rather than factual grounds. And the complexity of the interactions between all these components would make it almost impossible to understand why the model produces the results it does. The case for the kind of static, formal incidence, income-based microsimulation we are considering in this lecture rests on 4 properties. First, these models address genuinely important questions. Who gains and who loses from a reform, and by how much? Second, their outputs are relatively transparent and explainable. You can show a minister or a journalist precisely why the model produces the result it does. Third, they do not depend strongly on the analyst's prior beliefs. The same model in different hands, with the same data and the same rules, produces the same results. Fourth, they can be answered with reasonable precision and are genuinely useful for policy design. The long-run forecasting extension is worth understanding because it appears in lectures 6 and 7. The same reweighting technique used to correct for non-response bias in current data can be applied prospectively. Instead of reweighting the FRS to match current census population totals, you reweight it to match ONS population projections for 2030 or 2035, adjusting the age structure, household composition and employment rates to reflect official demographic forecasts. Combined with Office for Budget Responsibility, OBR, earnings projections, this produces a synthetic future, FRS, that can be run through the microsimulation model to produce poverty and inequality estimates for future years. The OBR is the independent watchdog established in 2010 that produces official medium-term forecasts of UK economic output, tax revenues, and public expenditure. This is not the model forecasting the future itself. It is the model applying external official projections to produce internally consistent distributional estimates. The distinction is important for honest communication of what the method can and cannot claim. The title of this conclusion, "A model is a tool, not an oracle," is the single most important professional attitude to take away from this lecture. In the practical demonstrations, we have started to build a model from scratch in Python. We have also spent considerable time on what it cannot do. Both halves are equally important. The first thread is what a model actually does. The model applies tax and benefit rules to each household in a sample, aggregates the results, and tells you the net fiscal cost, the gainers and losers, the marginal effective tax rates, and the poverty count. It calculates formal incidence, who is legally liable and entitled, not effective incidence. It calculates entitlements, not receipts. These are not small caveats. For a program with significant non-take-up, the model may overstate the caseload substantially while getting the aggregate cost approximately right. For a tax where incidence is contested, the model tells you who writes the check, not who bears the burden. The second thread is validation. Bottom-up and top-down validation are both necessary, and neither guarantees the other. A model can produce the correct total income tax revenue while systematically misclassifying which deciles pay it, if individual errors cancel out in aggregate. Conversely, a model can correctly attribute tax to specific household types while producing aggregate revenue estimates that diverge from HMRC data because its treatment of high-income households is wrong. Run both checks, report both. The third thread is the distributional accuracy paradox. The alcohol and tobacco correction is the clearest example. Multiplying recorded spending by a grossing factor to match customs data improves aggregate revenue prediction. But if the true explanation for the gap is undersampling of heavy drinkers rather than understatement by survey participants, the correction makes distributional analysis worse. It concentrates the implied tax burden on a small number of heavily consuming households, rather than spreading it across a larger population of moderate consumers. You cannot know which explanation is correct from the survey data alone. The honest response is to report both corrected and uncorrected estimates and explain the difference. The fourth thread is static versus dynamic modelling. The case for static models is stronger than it might appear. The labour supply response literature is genuinely inconclusive. Income and substitution effects partially cancel, and the net direction depends on which segment of the earnings distribution you are examining. A dynamic model incorporating a specific labour supply elasticity is not more honest than a static model. It is a static model with an additional assumption. The minimum alcohol pricing and sugar levy evidence is more encouraging. There is now clear evidence that price-based interventions change behaviour in the expected direction. Where behavioural evidence is strong, use it. Where it is weak, say so. The fifth thread is useful imperfection and long-run forecasting. The same reweighting technique used to correct for non-response bias, applying different weights to different household types, can be applied prospectively to ONS population projections and OBR earnings forecasts. This produces poverty estimates 15 or more years ahead without requiring new survey data or the model to forecast macroeconomic variables itself. The model does what it is good at, applying rules to household data. Forecasting the population and economy is delegated to ONS and OBR, who are better placed to do it. That division of labour is a model of how to extend a tool without overextending it. Lecture 6 introduces the Landman tax transfer model, a professional implementation of the principles built today, running on real family resources, survey data with the actual 2024 to 25 UK tax and benefit parameter set. The code structure will be familiar: load and uprate data, calculate taxes, calculate benefit entitlements, aggregate, output. What changes is the scale: 25,000 real households rather than a synthetic teaching dataset, and the institutional context. Outputs from this model have appeared in parliamentary evidence, peer-reviewed journals, and ministerial briefings. Today you have learned why those outputs mean what they mean and what their limitations are. That understanding is what makes it possible to use them responsibly. If you have access to an account, please move on to Practical Demonstration 4.